The next learning objective is adjusting for overallocated and underallocated overhead. Before we can do the final step for allocating overhead costs, which was step 3, we need to update our example so that's more realistic. Earlier, we allocated $50 of overhead to job 70. But realistically, Gabriella's guitar shop also finished other jobs and allocated overhead to them too. So let's assume these jobs were finished and had overhead allocated to them. Apparently there was a lot of direct labor associated with them because each one was allocated a lot of overhead. Remember, step 3 says to adjust overhead at the end of the period so its balance is 0. We have to do this because it's a temporary account. So we first must determine our balance. Adding our debits and subtracting our credits, we get a debit balance of $355. It's normal that we did not allocate the exact correct amount of overhead because we based our predetermined overhead rate on estimates and we made the calculation before the period began. Now it's time to do the journal entry to zero out the account. So how would we close this account so its balance is 0? Well, we would credit the account $355. So in our journal entry, we would credit manufacturing overhead $355. So now all we have to do is find out which account to debit. To do so, let's look back at our workflow diagram that showed how costs flowed through a manufacturer. So now we need to figure out which account to debit to match our $355 credit adjustment. Since we had a debit balance in manufacturing overhead, this means these costs never made it to a job cost record, like the $50 of manufacturing overhead allocated to job 70 in work-in-process inventory. And those work-in-process inventory costs eventually move to finished goods and then to cost of goods sold. So in this case, $355 of manufacturing overhead never made it to cost of goods sold. This means we underallocated or undercosted $355 of overhead. So the solution to our adjustment is to debit cost of goods sold, as I'll show you in the next slide. So all we need to do is debit cost of goods sold for the unallocated or undercosted manufacturing overhead. So remember, the manufacturing overhead account is a temporary account, which means we must make sure its balance is 0 at the end of the period. That's the reason for this journal entry. Now you may be wondering, what if some of the numbers changed and we had a credit balance in the overhead account at the end of the period instead of a debit balance? That means our estimate was off, which it almost always is, but in this case we overallocated our overhead. So once again we need to zero out the account. How would we zero out this account since it has a $100 credit balance? We would debit overhead $100. So in our journal entry, we would debit overhead $100 and credit cost of goods sold for $100. Notice this is the opposite adjustment from when the account had a debit balance on the previous slide. So let's recap the 3-step accounting for manufacturing overhead. Step 1. Before the period, calculate predetermined overhead allocation rate. The formula to do so is total estimated overhead cost for the period divided by total estimated quantity of the overhead allocation base. Gabriella chose direct labor costs as the allocation base. The accountant estimated that overhead costs for the period would be $3,200 and estimated that total direct labor costs would be $8,000. The result is a predetermined overhead allocation base of 40 cents. Then, throughout the period, on the left side of manufacturing overhead, we accumulate actual overhead costs as they occur. Things like indirect materials, indirect labor, plant depreciation, etc. Then, when a job is completed, we need to allocate overhead to jobs based on the job's size, which is determined by the job's allocation base. In our example, the accountant chose direct labor costs. So the more direct labor involved with a job, the more overhead the job is allocated. So when job 70 was completed, the accountant looked at the job cost record, determined there were $125 of direct labor costs, multiplied that by our predetermined overhead allocation rate of 40 cents, and got a total of $50 of overhead being allocated to job 70. So we lowered manufacturing overhead by crediting it $50 and added $50 of overhead to job 70's job cost record. We do the same for job 71, which apparently had $5,000 of direct labor costs, which means overhead is credited $2,000 and assigned to job 71's job cost record. And finally, we do the same for job 72, which apparently had $2,500 of direct labor costs and results in $1,000 being taken from the overhead account and added to job 72's job cost record. Then, at the end of the period, we have to adjust manufacturing overhead to close the account. We use cost of goods sold as the offsetting account. Before we can close manufacturing overhead, we need to determine its balance. And now we can start our adjusting entry to close it. To close manufacturing overhead, we would credit it $355, so it has a zero balance. And that is our credit account in the journal entry. And to finish the entry, we use COGS as the offsetting account.